2016 while I was still studying. Yeah, so always been very passionate about a broad range of things. Amongst it is really mathematics, finance, computer science. So when I discovered blockchain, I was immediately intrigued since it's like a nice overlap. Went quite technical quite soon, did some developments early on with Jasper, then decided to work full time with blockchain 2019. So then joined a company Intellectu that built decentralized applications for traditional financial institutions, so tier one banks, clearing houses. There, it mostly stayed with proof of concept, but luckily after my hours, I was with Jasper also building all kinds of MEV bots, about which we will tell a bit more later on in the pitch. But yeah, there we really saw the ins and outs of DeFi, and it's while building those MEV bots that the idea of Arcadia Finance was born, which we then started January 2022, so a bit over a year. Jose, Jasper, if you want to go next.
Yeah, I'll follow up. Hope the sound is good on my end. So I'm Jose. I have a background in venture capital. Led crypto for a VC fund in Europe prior to Arcadia. Before that, worked at the startups on the kind of operations and business side of things. And before that, I started my own company that ultimately failed. But it was a great learning experience. Prior to those experiences, I went to college in the US and studied economics. And I'm originally from Venezuela, which is kind of how I got in touch with the crypto space, because there's a big community in my country, and a lot of people use crypto or go into crypto out of necessity, and that was also my case. And yeah, thanks everyone for having us. It's great to be here.
All right, I'll kick it off. So with me, I have a background in the blockchain space that goes already back some years. Initially back in 2011, I did some small scale Bitcoin mining. Fortunately, at the time I wasn't the true visionary as I am now, so sold most of my stake over the years. But I did also see the Ethereum ecosystem growing and coming up. So it was quite fascinating to see. As Thomas mentioned, I've been around since 2016 doing blockchain developments, initially with arbitrage bots on centralized exchanges. And later on, when DeFi started to come up in 2020, 2021, made a number of MEV bots, all kinds of strategies, both the high frequency arbitrages, but also more the one-of-one strategies. So yeah, dove very, very deep into everything EVM related, Solidity smart contract related, and as such also start to note some missings within the DeFi space, some shortcomings, some things that weren't as efficient, and that eventually grew into what we're building now with Arcadia Finance. And I think with that being said, we can really dive into the protocol itself.
Yes. So maybe before we explain what we are building, let's first go in what problems we are solving. To explain that, let's go a bit back to our years as MEV searchers. So both me and Jasper, in our free time, 2020, 2021, we spent most of our days reading smart contracts, seeing if there was any arbitrage opportunity between various DeFi protocols on various chains, and if so, we wrote our proper bots. We're often first, we were more looking at the niche strategies, and really played the MEV game. So it's 1-2 weeks after a new strategy, participate in the gas wars with other MEV bots, and as soon as competition was too hard, switch to the next strategy. So while building those MEV bots, we really saw, let's say, the superpowers of DeFi, while we really believe in the space and think it is a big way forward. The composability between protocols is amazing. Concepts like flash loans really made us believe that this is the way to go. Also the open financial system that we can freely build and iterate on. So we really think DeFi is the way to go, but we also noticed a lot of pain points. So things that are not that efficient today, and that have to be solved if you really want to bring DeFi into the mainstream. And one of the things that was most difficult for us was collateral management. So collateral management was really a pain. So I think in the next slides, I'll explain why. So here you see, for instance, one of the strategies we used. It was to keep the peg of various stable tokens, for which amongst other we used maker or maker alike protocols. So I won't explain you how the exact strategy worked, but basically it's if token is under peg, you buy the token and redeem it. If it's above peg, you do the opposite. Here, for instance, with maker, you have to put collateral, and it is per the individual asset, we had to open an individual position. So for instance, if we wanted to use this strategy with 5 different underlying assets, we had to manage 5 different isolated individual positions. So this is not only time consuming, it is also capital inefficient, since you have to over collateralize each of the individual assets. And imagine now that in one vault you use USDC as collateral, in the other you use ETH. If the ETH value would, let's use the example, ETH and wrap Bitcoin. So I have 2 positions, one with ETH, one with Bitcoin. If the value of your wrapped ETH would drop, then you need to top it up. At the same time, your position with wrap Bitcoin might increase in price, but here the winning position cannot offset the losing position since they're both isolated, meaning that we have to top up the wrapped ETH, while in theory, our wrapped Bitcoin position could compensate it. So capital inefficient, hard to manage, and our collateral was spread over multiple positions. This is true within a protocol, for instance, as Maker, but the biggest problem is that we interacted with, let's say, 30 plus protocols. Each of them required some form of collateral, and our capital was completely scattered across 30 different protocols, and even within a single protocol, sometimes multiple positions. So to manage all of this, a real pain and capital inefficient. Another thing we noticed, for instance, one of our other strategies used NFTs, but it was the only strategy where we used something different as the vanilla ERC20 tokens. So how the strategy worked is we listened to all listings on OpenSea, and we monitored the floor prices of protocols like NFTX or NFT20. And if an NFT was listed below floor price in one transaction, we would buy the NFT from OpenSea, we would sell it or deposit it in the NFTX vault, and then immediately atomically sell on SushiSwap the wrapped ERC20 tokens of that NFT with a profit. So here we saw that DeFi could work with different asset types than just the vanilla ERC20. But so far, all protocols built their whole protocol around a single asset type and not around assets. So for instance, there are some lending protocols against NFTs, but they only allow lending against NFTs. There are some protocols around lending of LP tokens, but they are really only focused on LP tokens. So there is no holistic approach where a user can use really their basket of quality assets and use the whole basket at once to borrow against. And something that in decentralized finance is very possible. So I think you already hear where you're going. That's exactly what we try to solve with Arcadia Finance. And so to summarize, DeFi today still has a lot of frictions, and most of those have to do with collateral. Why do you need collateral in DeFi? It's to manage counterparty risk. So we believe that today every protocol sees it as an individual problem that they solve within the protocol itself. But we think that there has to be a generalized way to manage counterparty risks between peers or even between peer-to-contract interactions on chain. So it should not be isolated per protocol, but it should be on an account level. So the solution is what we're building with Arcadia Finance. In traditional finance, you also have the concept of margin accounts. That's exactly what we want to build on-chain, but completely adhering to the Web3 principles. So fully decentralized and non-custodial user-owned margin accounts. I think in its simplest form, you can see it as a kind of smart contract wallet where a user can deposit all their assets. So here, for instance, you see a user that has ETH, it has some collectible NFTs, and it has some DeFi primitives that can be of different token standards. So they have, for instance, a Uniswap V3 liquidity position. So the account can accept a whole range of quality assets independently of their token standard. So what really matters is that the underlying asset is of quality. And with of quality, we mean that you can price it on chain reliably, that there is liquidity for the asset on chain to sell it, and that the asset itself is immutable, that it cannot be manipulated with, for instance, a rogue dev that can mint additional funds. Next to the assets, the margin account can also manage liabilities that are issued against those assets. Most straightforward example are loans. So in a margin account, if a user has 15,000 of value in assets, then the account allows loans against those assets up to, for instance, 100,000. With our margin accounts, we generalized as well liabilities. So today, lending is still one of the most used DeFi principles, but there are different financial instruments where also liabilities have to be managed. Think of if you write out options or with future contracts, one of the two peers in a future contract is probably out of the money, so they have a liability against the other user. So our margin accounts do the accounting of both, so they can for each user determine what is the complete amount of assets, and against those assets, the user can have a number of liabilities. Most important here is that the risks are always managed so that the asset side is at all times higher than the liability side. As long as the user adheres to those principles, so as long as the asset side is bigger as the liability side, the user is still free to do with his own assets what he wants. So in a permissionless way, where a user can still use assets or issue new liabilities with any other DeFi protocol. So really, in its core, you can almost see an Arcadia margin account as your MetaMask wallet, only with the MetaMask today, it's more like a debit card. So you can only use the assets that you possess in your MetaMask. With an Arcadia margin account, you can see that you can both use the assets you already have in your margin account, but you have the option to also use credit, so to borrow funds and use both your own assets as borrowed funds to interact with the rest of DeFi. So if we compare it with how DeFi looks today, as mentioned, collateral to manage counterparty risks is isolated and fragmented across different protocols, or even for a single protocol across different positions. So there's no holistic way to manage assets and liabilities. That's what we want to change with Arcadia margin accounts. So with Arcadia margin accounts, we see an underlying new DeFi Lego block, a new piece of infrastructure that does the management of collateral and that guarantees that each individual user has a balanced account, so that each user has more assets than liabilities, and as such, all counterparty risks are managed. And this is also cross-protocol. So a single user has one place to deposit all their assets and one place to open up multiple positions. Straightforward advantages are, again, if you use the example of a user that borrowed against both ETH and Red Bitcoin, if now the ETH price drops, but at the same time the Bitcoin price increases, then the overall position is still healthy, and the rise in Bitcoin compensated the drop in ETH. So our user does not have to do additional steps and over collateralize the ETH position. It's really cross margin. So yeah, that are some of the benefits of our margin accounts, and I hope you here see how it changes from the as-is situation. So in short, it is a single account where you can go cross margin. It is fully user owned. So if I say we, I really talk about our smart contracts. So each user that has a margin account really has deployed its own smart contract where they are the sole controller. So they're the only ones that decide what to do with the assets. So we as Arcadia Finance just provide the infrastructure to build and deploy it. As soon as it is deployed, we have zero say or powers over the contracts. We guarantee that counterparty risks are managed in an immutable, transparent way, the code of our smart contracts. And the account executes and holds all funds and executes any transactions that a user wants to do.
All right, thank you, Thomas. I will continue walking you through a couple of the properties of these margin accounts and go deeper into a couple innovative features, innovative thoughts behind these margin accounts, and also explain to you why using margin accounts is actually much more capital efficient. So first, talk a little bit about the token standard agnostic properties of the margin accounts, what kind of assets can be used as collateral. Then we go over the non-custodiality of the margin accounts, but still with a twist that is upgradable by the user. Also, how we see composability within DeFi and with other DeFi protocols. And then we have another slide on permissionless interactions that a margin account can do. So really about the token standard agnostic way of working. As Thomas mentioned, many DeFi protocols, whenever they're building their product, they're always working with a single token standard, and their entire architecture is based on a single token standard. And in the past, it often was the ERC20 token. Now, what we see more and more coming to chain are more complex financial products. Think of options, of futures, even of LP tokens. And most of those new financial products, they don't fit anymore into that simple ERC20 standard. And so we see more and more of those ERC standards coming up, each with their own use case, with their own abilities. And so for us, it was very important that whenever we made the protocol, that it was made in such a way that we wouldn't be dependent on the technical implementation of the assets to allow it as collateral. We all know how fast DeFi moves. If you make your protocol now only for example, ERC-4626s, the sort of newest type of assets, maybe in a year there are already other ERC standards and other ERC assets, and you're completely lagging behind. So we've actually used a very modular way of allowing new types of assets. For example, if there comes a new ERC standard for example, bonds or for stocks that come on chain, we can simply make one pricing module for it. We did the logic on how do I price this type of asset, and then append it to the existing protocol. And from that moment on, any user that already has their margin account opened, that already has deposits funds in it, already has liabilities against it, can then simply start using that new asset type. So we're only limited by, of course, the risk profile of the asset. It still has to be a quality asset with some of the properties that Thomas mentioned previously, but we're not limited by the technical implementation of the assets, and even not of technical implementations that currently don't exist yet. So really in a token standard agnostic manner. Then about the upgradability and the non-custodiality. So for us, it's also very important that whenever a user opens a margin account, that it is really considered to be the margin account of that user. Only that user is the owner of the account. Only he or she can withdraw assets, deposit assets, perform some other actions. And there's no action that the Arcadia protocol or even we, the devs, can do with a user's margin account. We have no say over it whatsoever. But it could be that maybe in a couple of months, we introduce a new margin account, a new logic with some new features, maybe some gas optimizations. And it could be that you as a user want to use a new version as well, want to make use of those new features. So we have foreseen that these margin accounts are upgradable proxies, but the upgradable proxies can only be upgraded by the user themselves. So we as a protocol, we can just say, okay, here is version 2, and in this way you can upgrade to this version 2 with some new features. And then it's up to the user to decide, do I want to upgrade or not? If he wants to upgrade, it's just a simple click, no need to migrate funds or close financial positions. And if the user doesn't want to upgrade, doesn't want to use those new features, fine as well. They can just continue using their existing version. But it gives the user an ability to keep continuing, say, the newest features that we develop without compromising on the permissionlessness or on the non-custodial way of working. Then about composability, in my opinion, really one of the magics of DeFi, composability. So when making the margin accounts, and as well actually our lending side, composability was always really on top of our minds. So the margin accounts themselves, they are according to the ERC 721 standard. So they are actual NFTs, which also means that your margin account, you can transfer it or even sell it on existing NFT infrastructure, like some trading platforms of NFTs. You can really see your margin account as a single asset in itself that contains a bunch of other assets. It also allows the margin accounts to be easily trackable in other already existing infrastructure. Think of the Zapper or DBank, you name it. And it's also in not only is it the margin account composable in the asset type that it is itself, but we'll also talk about it later on a little bit. It's also very composable in how it can interact with other protocols and how other protocols can interact with the margin account. But more on that in a couple later slides. Then the permissionless aspect. There are quite a lot. I just want to focus here on one of the most interesting aspects. A user account can have, or user margin account can have assets in it, even liabilities against it. But as Thomas said, you can actually still use your assets within your margin account, given that you don't end up in an invalid state or in an unhealthy state. But imagine you have your margin account with some assets in it, and you want to, for example, swap the assets, or you want to stake your assets somewhere else. You can actually do that. So in a permissionless manner, you can interact with any other DeFi protocols with the assets currently in your margin account, as well as with any borrowed funds as well. So in this case, we can create a single transaction, and we have a couple steps that we can do. So first of all, you can do a flash withdrawal. So a flash withdrawal is really, you have your margin account, you have liabilities against it, but you can still withdraw any asset from your margin account. You can then do a flash loan. So essentially mean you can borrow optimistically however much you want, and then use both the assets that you have withdrawn as well as the assets from the flash loan and do, again, whatever you want within DeFi. Swap it for another asset, stake it somewhere, claim an airdrop, you name it. And at the end of the transaction, of course, you have to deposit whatever funds you have back in your margin account. There is a single health check performed of the account, meaning whatever just happened is at this point in time the margin account in a healthy state. Can the assets, can the collateral within the vault cover all open liabilities? If so, it was a valid transaction. If not, the transaction will revert and nothing happened in the first place. So that actually allows us, or the principle of the flash withdrawals and the flash loans actually allows us to interact from your margin account with any other DeFi protocol, as long as at the end your vault or your margin account is back in a healthy state. What we currently have on Arcadia Finance with our product is a leverage trading application, or using leverage where you can interact with on other DeFi protocols. But these margin accounts, they can actually be used for much more than just lending, so to say. It can actually be used by any other financial product that needs to manage counterparty risk. So imagine that you are a protocol building around futures or around derivatives or around escrow, then you can actually interact with a margin account to issue liabilities against. That's actually also how we do it. So we actually have two products. We have our margin accounts, and on top of those margin accounts, we have our own lending protocol. And that lending protocol is actually completely standalone product that issues liabilities against the margin accounts and uses the margin accounts as collateral. Yeah, that's what we call with the Arcadia V1, and I think Jose, you will be speaking more about the Arcadia V1, what you can do with it.
Yeah, thanks, Jasper. So essentially, like Jasper said, right, we build a first product on top of the margin accounts, and this is a leverage lending protocol. I'll talk a little bit about it. So some of the limitations of current lending protocols and why we decided to build this first iteration on top of the margin accounts is essentially when you go on Aave, for example, today, right, two things are true. So one is you deposit 100 and then you can only take out 80. And then number two, you deposit your deposited collateral has to sit there idle and unutilized. And both of those things are not really capital efficient, and it's really, we think, not what's going to take DeFi to the next level. So with the lending protocol that we build, what's different is that not only you can borrow up to 10x the value of your collateral, but also use the assets that are being held as collateral. So you really can use both your deposited collateral and the borrowed funds to do whatever you want in DeFi. And that's what we call capital efficiency. And that's the purpose of this lending protocol that we built. The way it works is it's really as a two-sided marketplace. So on one side, you have the lenders that provide liquidity to the protocol, and then they earn a passive fee by doing so. And then on the other side, you have the borrowers who access leverage to perform permissionless actions on chain, and then they pay an interest to the lenders, and that's the APY that the lenders get. So this is in a nutshell. It's a marketplace, and it's in a nutshell how the protocol works. I'll try to keep it as simple as possible. Then let's talk a little bit about the lenders side of the protocol. So lenders are liquidity providers, and the way they interact with Arcadia is, like I said, by supplying their assets to the lending pools and earning a passive return for doing so. The lenders then, so the liquidity provided by the lenders is then lent out to the borrowers in the form of margin, and the lender gets a yield-bearing token to which the interest and rewards accrue automatically proportional to the share of the pool. So essentially how it works in most lending protocols. One of the things that's really cool about Arcadia, though, is that we introduced multiple risk tranches. So when you're lending your assets to a protocol, right, effectively what you're doing is underwriting risk, right? But the problem that we solve right now in DeFi is that there's very little control for lenders on the risks and the returns they incur for providing liquidity to protocols. And so with Arcadia and the multiple risk tranches, we're trying to change how that works. And so I'll briefly describe kind of the both tranches. So right now we're live with two tranches. You have a senior tranche and a junior tranche. The senior tranche receives yields by accruing part of the interest paid by borrowers. The senior tranche is shielded by the junior tranche in the case there is bad debt. In return, yields of the senior tranche are, of course, lower than the yields you'd get by holding a junior tranche, right? And then the junior tranche receives yields from interest paid by borrowers and also receive additional yield from liquidations. So actually the junior tranche accrues a portion of the liquidation fees in the protocol. So the junior tranches would have higher APYs than the senior tranche. However, in the case that a debt position becomes under collateralized, the junior tranche will be the first tranche to lose part of the principal to write off the bad debt. So that's effectively how the multiple risk tranches work. Let's go to the next slide, please. And this, some of the characteristics for lenders, right? So it's peer-to-pool, it has multiple risk tranches, and it really uses the familiar mechanism that's widely used by other lending markets. So people, can feel comfortable about lending in Arcadia. Now, a little bit about the borrow side. So like effectively, if you're a borrower on DeFi right now and you want to access capital, like the most efficient way to do it is basically looping on over collateralized lending protocols, right? So repeatedly borrowing and depositing over multiple protocols depending on your size. So this is the most efficient way to access leverage on chain. And this is, of course, not super capital efficient, right? And so with Arcadia, what we're really trying to give borrowers is the ability to access on-chain leverage in a single action. And the way it works is you open a margin account, you deposit initial collateral into that account. You can deposit multiple different assets all in one go. And then you basically have, you can access leverage in one click to do whatever you want. The mechanism we implemented, like Jasper mentioned, works similar to how flash loans work, in the sense that users can do whatever they want with their borrowed capital, as long as two things are true at the end of the transaction. One, you deposit back your resulting assets to your margin account, and number two, the account performs the health check, and then indeed your assets are enough to cover your open liabilities at the end of that transaction. What happens in between is really up to the borrower. And that's in a nutshell how the kind of the mechanics from the borrow side works. Now, there are many things that you can do. Three things that we're focusing on are, one, like borrowing. So you would go in the app, you would borrow 10x the value of your collateral, and then you can also borrow against your entire portfolio of assets, including, like more long tail or exotic assets like quality LP tokens, i.e. Uniswap V3 LPs would be one example. Then you can use those assets to trade on margin. So you would basically go on the app and put out a trade. And then one of the cool things is that because we do not have an order book of our own, the app the protocol is able to route every trade through the most liquid DEX, resulting in the lowest slippage available for the user. And then the third thing that you can do is invest. And by invest, we mean, basically leverage yield farming and leverage LPing. And so you basically can do what you guys already do, right? But with boosted yields and in the most capital efficient way. In the next slide, you'll see kind of some strategies that you can do. Like it really, like this is just an example, but there are many things that you can do. One cool thing is, for example, performing pair trades, right? So going short one asset, going long another asset, and capturing the spread between the two. All the cool things are, leverage yield farming. You can, for example, provide liquidity to Curve3 crypto pool on leverage. You can provide liquidity to ETH wrap stake ETH pool on Balancer and 5x leverage. And you can leverage up on your ETH while earning boosted yields. Like all these things are possible with Arcadia, and like honestly, many more things. The way it works under the hood, like we have been kind of mentioning before, is combining the margin accounts, which are the core protocol, and then on top putting a lending protocol. And so the way it is the margin accounts are the liabilities for the lending protocol. And so that's kind of the mechanics under the hood. And we can, kind of dive deeper into how this looks and some of the functionalities of this. I'm not gonna do it right now. And then, so probably the last thing that I'd say is, with Arcadia, we really think we're kind of changing the way DeFi works. And so the purpose is, if you look at what DeFi looks like today, right, every new position is a new line of credit. With Arcadia, we want you to be able to borrow against your entire portfolio of assets. If you look at DeFi today, the capital that you can access by borrowing is less than your deposited collateral. And with Arcadia, we think that the way to go is for you to be able to access more borrowed funds than the value of your deposited collateral. And then finally, in DeFi today, most of the things you can do involve ERC20s, but most people hold more than only ERC20s. And so the purpose of Arcadia is also to unlock liquidity on these underutilized quality long tail assets. And I think with that, it's probably a good place to end the presentation. Again, thanks everyone for listening, and then maybe let's open up the floor to some questions if you guys have any.
Thank you, Jose, Jasper, and Thomas. So let's open up the floor for questions. Do we need to bring you up, right, to ask questions? So please raise your hand, and we will bring you up to the stage.
You can also type questions into the chat if you like.
Yeah, of course. Yes. I can't speak.
Can you guys hear me?
Yeah. Hey, K-Mets, how's it
Yes.
going?
Yes.
Hey, how's it going, everybody? Thank you so much for the presentation. That was really really pretty cool. Pretty innovative stuff you guys are putting together. I had a question on the margin accounts and utilizing the collateral. Are you guys pricing the collateral with oracles?
Yeah, that's a good question. We basically have two big classes of tokens. So we have tokens for which we have a direct price feed, indeed via an oracle. Those are, let's say, the vanilla ERC20 tokens, governance tokens, or for instance, floor NFTs. So therefore, each asset we have a direct oracle. And then the second class of tokens are more the derived tokens. So we'll use as example a Uniswap V3LP token of USDC wrapped ETH, for instance. There we don't have a price feed per Uniswap pool, but instead, in a flash loan resistant way, we calculate the underlying amount of tokens for which we then do have a direct price feed. So if you have Uniswap V3LP token in your margin account, then our pricing logic will first derive that LP token is worth, for instance, 5 ETH and 10,000 USDC, for which you then both have a price feed, and as such we can at each moment in time on chain derive the price for the whole basket of assets by summing up the individual value of each. I hope that answered the question.
Sounds good. I have one as well. It seems to me like you have to have some kind of dedicated module to be able to understand your liabilities and whether they can be liquidated and how they can be liquidated. How does that, like when a new liability, like when somebody wants to deploy their funds in a way that hasn't been done before, like is that work for Arcadia Finance to build a kind of like a module, or how do you go about adding in new types of liabilities, and who's assessing the risk of those?
Yeah, I'll take that one. So currently we are working with quite, say, risk conservative approaches on adding collateral. We're currently only live with the one of the more liquid ERC20 tokens that will change in the coming weeks. Currently, it is indeed us as the protocol devs that are, let's say, looking for what kind of collateral assets are the most demanded by the users, and then start working on adding those kind of collateral. So for the collateral, let's say to assess the quality, we always work with a couple sort of a checklist, some checkboxes that have to be checked for every asset we allow as collateral. One being that there has to be sufficient on-chain liquidity for the asset, because we assume that all of our liquidations will always be atomic. So you have to be able to sell your assets atomically. You need on-chain liquidity. Second is that the historic price volatility must be acceptable. Crypto is volatile, of course, but it still has to be within acceptable boundaries. And the third one is that there are no, say, known flaws in the token design, no death spirals, and no god powers to the devs. As soon as those checkboxes are checked, we then sort of feed all of that data, all of that information into our risk models. And our risk model will then spit out a couple of numbers, one being the collateral factor, so it's the haircut against the spot price, the liquidation factor, which is the say the factor at which the asset will be liquidated, And the third is the overall exposure of the protocol against that certain asset. So to prevent, for example, that you suddenly have a position that is 90% of the entire market cap in a single position, a single margin account, to prevent these kind of attacks. In terms of interacting with other DeFi protocols, with say other staking platforms or whatnot, what is important is that the recipient tokens of your actions in your black box, whatever you did within DeFi, that the recipient tokens of it can be deposited back into your margin account, which implies that that recipient token is indeed part of the allowed collateral. So you don't need to do any work for, let's say, making the strategies, but you have to be able to work with either allow listed collateral as the end recipient token. And if that end recipient token isn't allow listed yet, then it's indeed up to us or as the core team to develop a pricing strategy for it if it doesn't exist yet.
I see. And then so when you develop those pricing strategies for it, let's say that it passes your risk model, then you can deploy that as a module that can be immediately tapped into by an already deployed account, or is that something that requires an upgrade?
No, it will depend, of course. If, for example, it is, let's say, a Uniswap v3, which we'll introduce quite shortly in the near future, then everybody will already has an opened margin account, even with assets deposited in it, even with borrowed funds against it. They can immediately start using that new allow listed assets. They don't have to do any upgrade whatsoever. If it would be related to a asset of a new ERC standard, then it might be that we have to make sure that this asset can be transferred, can be handled within the margin account. And then we can offer a new margin account, for example, margin account in version 2. And then the user has to upgrade their margin account. But as I said in the presentation, it's just a single click. You, again, don't have to close any positions or withdraw assets or migrate funds. It's always a very simple user experience to upgrade your margin account version to then be able to use, for example, the new transfer functions related to a specific ERC standard.
I see. So basically, as long as the new collateral you're adding conforms to a token standard that you've already built into the contract, then it's just a question of a pricing module.
Yeah.
Is that? Yeah, I see.
Yeah,
okay.
Indeed. And if it isn't, then it's for a user just one additional click.
Right. Yeah. Okay. I see that Subli's posted a couple of questions in text. I can relay them on his behalf, or you can respond as you like. His first question is, what are the different reasons for bad debt, and how do you plan to mitigate them?
Yeah, so bad debt, maybe to clarify, put more context to it, when does it occur? So whenever a position, when the liabilities come too close towards the total value within your margin account, a liquidation will be triggered. And liquidation in Arcadia is a two-step process, where first the liquidation is initiated, and as soon as the liquidation is initiated, a Dutch auction starts, so the decreasing price function. Then at any point in time, whenever there is a purchases, someone wants to buy the position with all the assets in it at the price point of that price curve, then just buys the whole margin account, stops the auction, settles the debt, and that's it. Now, it could be in theory that nobody's either interested in buying these margin accounts, or that for some reason there is just no one awake. In the case, of course, everything is automated with liquidation bots. But it could be that the eventual position or the eventual margin account is sold for, let's say, fewer value than the open liabilities against it. And in such a moment in time, you have open debt, and there's a lot of paid back put to the protocol to cover or to close the entire debt position. And then you have bad debt within the system. How you can mitigate it? I think it does start with a very good risk model with risk parameters that are set in such a way that it aligns both the incentives of the liquidity providers as for the borrowers. It's a fine line to walk there. I think with Arcadia, we start very conservative with conservative risk parameters, especially since we just launched, want to make sure that everything works as desired, which has been working as desired, luckily. So it's a matter of fine-tuning those parameters where needed, making sure that you don't have a too high exposure to a single asset as compared to its on-chain liquidity, because you have to take into account slippage when you would to liquidate a large position, etc. I'm not sure, Thomas, if you want to add something on the bad debt story.
No, I think that was
Alright.
clear. So I can go to the second question maybe. So around as concentrated liquidity for Uniswap V3 is being forked, should we expect Arcadia to accept LP tokens from other dexes such as Velodrome and Optimism? So here, yes, we will definitely look at other dexes. If the other DEX is, let's say, an exact copy of the Uniswap V3 code, then we are out of the box integrated with it. So if they didn't do any modification at all, we can actually use the same pricing logic for a Uniswap V3 LP token, also for any forked version of Uniswap V3. If they also use concentrated liquidity, but modify the Uniswap code or build their own DEX with concentrated liquidity from the ground up, then we have to write an additional pricing module. So that's a bit more work on our side, but it's definitely possible, and we will definitely look into more DEXs. Uniswap V3 is just the first pricing module that we will deploy in the coming weeks. But after that, we will do much more. So here as well, if there is one particular that you're very active on, or want to use some leverage strategies, or you want to hedge one of the two tokens, please reach out, and then we can put it on our to-do list with pricing modules for different protocols to integrate with.
And regarding Velodrome, we've been talking with the core team for the past weeks. That's what we can say right now.
VNFT, we have been talking about it, yes. I think one of the problems right now is, if I remember well, that there is no on-chain liquidity. So at the moment, how it currently is, we cannot accept it since you cannot liquidate it atomically, meaning that for our current liquidation strategy, it would not be possible. As soon as there is a way to atomically liquidate the NFT, then we can indeed also use it as collateral. But we have also talked about it with the Velodrome team, as Jose just mentioned.
Yeah.
Could you?
I actually have a question. Yeah.
Oh, go ahead, Charlene.
I
Go
have a
ahead.
question. So there are some similarities with Alpha Finance and Gearbox here. Do you want to highlight the differences?
Yeah, I can take that question. So I think there are three. I'll talk about Gearbox. It's the question we get frequently. So I think there are three differences. So on one side, the way Gearbox works is through permission connectors, whereas Arcadia works in a permissionless way, in the sense that you can do whatever you want with the borrowed funds, as long as the two conditions that we've mentioned before are met. Gearbox is not permissionless in that sense. Rather, there's like a wide list of protocols that they can integrate via their permission connectors. Second difference is that Gearbox is composable, but only on one side with the protocols they can integrate, whereas Arcadia is composable on two sides, meaning not only we can integrate with other protocols, but also other protocols can issue liabilities against the margin accounts, which is not something other protocols can do in Gearbox. And then maybe the third difference is that Arcadia was built in a token standard agnostic manner, and Gearbox architecture is not the case. So with Arcadia, Like we said, you don't require any liquidity migrations or protocol upgrades to be able to append a new asset standard as collateral. Not the case in Gearbox. So I think those are the three big differences.
Cool. Do you also want to talk about Alpha Finance? It was very successful at some time before, right? And the model, broke for some reason.
I'm not really very familiar with the technicalities of how Alpha worked. So I don't think I can really answer that question with the best information available. I'm not sure if Jasper and Thomas, you guys are more familiar with the mechanics of that protocol, and then you can take it.
I haven't deeply studied their technicalities indeed, neither. So can't really give an informed opinion.
Yeah, sure. It's also just mostly leverage support LPs, and yeah, it was very $1 billion, just disappeared for some reason. So I'm actually quite interested to find out what happened there. And actually, I have another question. It's just so you guys are building on optimism. Can you comment on what are the challenges to build on optimism or layer 2 in general?
Yeah, sure. So let's see where to start. Yeah, I think maybe important to mention is that we deployed on both mainnet and Optimism. So we are on 2 chains at the moment, and we might go to additional ones. Why we did choose for 2 and not more from the start is also, I think, one of the major issues with having a lot of layer 2s. It's of course you are again fragmenting liquidity. So yeah, where we started with the core problem we saw in DeFi was that capital collateral liquidity was fragmented over lots of protocols. So with Arcadia Finance now on one chain at least, we want to solve it with a margin account. If we can go to 15 different layer 2s, yeah, then again we're fragmenting liquidity. So I think that's the first problem or challenge with layer 2s. Something we didn't mention here is that we are already drawing out the Arcadia V2 protocol. So that's the same use cases, the same ideas, but with some major upgrades, of which one is that we are investigating if we can use margin accounts cross-chain, meaning that you could deploy a margin account, for instance, both on mainnet and on Optimism, deposit collateral assets in your mainnet account, and then use the assets in your mainnet account as margin to open financial positions in your layer 2 that are, for instance, much more gas efficient, much more gas using. So I think, yeah, that's something we research, but also where we see a lot of technical challenges, since you both need instant and as trustless possible communication, both layer 1 to layer 2 or layer 2 to layer 1 or layer 2 to layer 2. I think the biggest challenges is how, with all the layer 2s that are upcoming, can we not end up in the same situation as DeFi is today, that capital portfolios are fragmented again, then not over different protocols, but over different chains. More on the technicalities, I think there deploying and working on Optimism was quite smoothless. So we built our whole protocol initially with mainnet in mind, and to then, let's say, fine-tune some functions or testing everything on Optimism actually was quite a good experience. So there we see that the tooling and support is really there. So cannot really say that we had any difficulties with deploying both on mainnet as Optimism.
Thank you. Do you have any other questions?
So before we go, and in the case there are no further questions, so I just wanted to just quickly kind of say, like, if so we recently closed our seed round. It's not publicly announced yet. It will be soon. But because we were oversubscribed, and that we have many good partners that wanted to chime in as well, but they were a little bit late. We are extending the round via a SAFT, and the core reason or the purpose of the round that we're extending is to target a specific DeFi communities and DeFi power users. And so we really wanted to, get in touch with Aladdin DAO, because I know you guys build the entire DAO with kind of this mentality of shifting, crypto investments from like VCs to like the crowd. And so I think we are aligned on that. And so just wanted to say, if there's anyone or the DAO or any specific members from the DAO that are in this call that would like to talk about this, would like to learn more about the round, and would like to, potentially participate, we are more than open to answering questions and informing you guys more about it. We are already allowing some people from Degen Score to participate, and we're doing this with other DeFi communities. So let us know if that's the case. So just wanted to say this before we close the call.
Thank you for the offer and thinking about us. And for Aladdin DAO, I think I passed that message to Subli as well. And just our current funding priority is around development and community building. But later on, we should definitely consider good opportunities like this. And for any community members who are interested, probably you should reach out to Jose and the team directly. I think Supli has one more question, right? And then we should wrap up for the meeting.
Yeah, sure. I'll take that last one quickly. I would say that perps indeed are now capturing big part of the markets, but perps are perfectly suited basically if you're really gambling on price direction. With the perp contract, you don't have any exposure to the actual asset. You have exposure to a derivative contract that mimics the price. So for purely highly speculative, high leverage trading, perps indeed have the liquidity. With Arcadia Finance, it's different. If you take a leverage position with margin, so with Arcadia Finance, you really have the spot asset leveraged long. So if you have a long staked ETH position, your leveraged position is also earning yields. So it is the real underlying asset. And if it's an asset that has yield, that has voting rights, that has airdrops, you name it, you also have the right on all those voting rights or underlying yield. So I think perps are a different market than margin trading. For us, it's more people that want to build up leverage positions to gain from spreads to yield farm, or in the mid-long term to get exposure to an asset, but to the actual asset, and also to the value that that asset creates. So I think that's a major difference. And secondly, with perps, since it are not the assets itself, you lose the composability of DeFi. One perp contract only lives within the trading environment of the DEX that offers that specific perp. It's not something that is composable with other DeFi applications, since it's really a different asset. With margin accounts, since we do have the actual assets and have something fully composable, you can really use the assets. And a big advantage there, for instance, if you want to trade really big sizes, with the perp, since it is only within a single trade environment, you're limited by the liquidity in that particular environment. With Arcadia, it's different. We are not building any trading environment ourselves. We don't have order books or matching engines. We just route trades that people want to do over one or more DEXs. So for instance, if you want to do a big size trade of a leveraged position, wrapped ETH to Bitcoin or to USDC, We currently route through 1inch. So the actual transaction can go over 5 different dexes with different shares and different pools to really guarantee lowest slippage possible on the entire chain, taking into account all possible dexes that live there and not just the single trading environment of a perp. Right, you're welcome.
Great. And I think that comes to the end of the presentation for today. So thank you guys for the presentation and all the insights shared. And thanks again, Thomas, Jasper, and Jose for your time. We have definitely learned a lot. And we'll pay attention to your next steps and look forward for opportunities for Aladdin and Arcadia communities to collaborate in the future.
Likewise, it was a pleasure. Thanks for having us, and I want to all wish a great next continuation of the day.
Thank you,
Thank
Charlene.
you.
Thanks so much for having us, and enjoy the chat. Have everyone a great day.
Thank you,
Thank you
guys.
all for listening in. See you.
Thank you, everybody.
Thanks for coming, guys.
Okay.
Thanks so much.
Awesome.
Thanks, everyone. Have a good day. We'll end even now.